What is up, everybody? My name's Cole. I'm a part-time real estate investor, full-time legacy airline pilot, and a part-time military instructor pilot. Today, I'm going to be making a video all about equity. What is equity? How do I use it? And when do I use it? And I'm going to be using my very own portfolio as a lens to look through and learn about it together. The first thing I would want to say is, what is equity? Equity is generally what you owe on a property versus what it's worth. So if you buy a property for $100,000 and let's say you use a VA loan, so you put $0 down, and the appraiser comes out and says it's worth $150,000 when you're going through the due diligence and the underwriting period with the bank. If they say it's worth 150, then your equity would be the spread between what it's worth and what you owe on it. So in that case, your equity on that would be $50,000. And it's important because in the United States, about 45% of people's net worth is wrapped up in their actual home value. So for a lot of Americans, that makes up the majority of their actual wealth. So understanding equity and how it applies to your own life is really important, even if you're not going to build a real estate business. But I think in the lens of building a real estate business, it's the most powerful tool that you have. I talked about cash flow in the last video, and you guys saw that even though we bring in over $55,000 a month in gross rents, we actually don't see very much of it, especially on a month where not a lot of people pay. Equity, though, is something that's going to continuously be building generally. There are some caveats to that, and it can be a lot more powerful and can grow a lot quicker than your cash flow will. So let's go through it. I'm going to throw up an Excel spreadsheet that I use all the time when I'm working with banks, showing them the portfolio and how it all works. I blacked out some of the information that's not applicable for today's video. It's not that I'm trying to get one over on you guys. The right side of the sheet is just all about cash flow, and some of the other information just isn't applicable for today's video. So I tried to keep it focused in on what is important. And the stuff that's important today is the total value of the portfolio, which you can see is by the end of the month should be about $5.9 million, just under $5.9 million, against a mortgage debt total of about $3.5 million. So you can see there's a spread there, right? It shows about 60% loan to value, which is a decent sweet spot to be in. 60% loan to value just means I owe 60% of the value of the properties in a mortgage. As you can see, my portfolio is built up with a lot of smaller deals. There's no really massive deals. There's one that was relatively recently that was a little bit larger with a value of about just over $1 million. But for the most part, you can see these are all smaller deals. Some of these deals are just over $100,000. There's not these just massive equity numbers that you'll see here because this is real life. This is a real portfolio. And a lot of people are going to sell you 20, 30, $40 million transactions. But if you're starting out and you're working a full-time job and you're not already really wealthy, this is the way that you're going to have to build it, because you're going to have to build a reputation with the banks. You're going to have to slowly but surely build up that portfolio, and you can see that's exactly how we've done it. Now, there have been some adjustments. We've sold some properties along the way. The 8-unit was on here. It's gone. We sold a couple duplexes that are no longer on here. And if you look at the very top, the first property that shows is from 2021. It's not the first property I bought, but it's just the oldest one that we have in the portfolio. And its loan to value is 35%. And you might be saying, like, how is that even possible? The way that it's possible is because there was originally 3 duplexes on here, and we sold one of them, and all the money that we made off of that, with a small exception, was used to pay down the existing mortgage. So we only owe $131,000 against a pretty large market value for those 2 duplexes. So that's how you end up in some of these interesting situations. But a lot of the rest of it is all just erosion over time, and I'll explain that here. A lot of the rest of it is just time in the market. As a famous investor once said, time in the market is better than time in the market. And in this case, it's absolutely true. You can see our loan to value averages go up as you get closer to present day. So that if you reverse engineer that, you can say, okay, the longer that you've had a property, the lower your loan to value generally is. And here's some of the reasons for that. The first one would be buying below market value, right? If you can get a deal off market or maybe even on market that you can negotiate to a pretty low price, now you already have baked in equity. I've done that a couple of times where I bought properties for under what they were worth on the market because I was able to close fast, I was easy to deal with, or I just had a personal relationship built up with somebody. And so in those situations, you're already buying into an equity situation. You maybe are paying $80,000 for something that's worth $120,000. And you might ask, why would somebody do that? A lot of people are looking for an easy transaction. So if you're easy to deal with, you're not giving them a lot of problems, you're not nickel and diming them, I think you can really build yourself in a position where people want to deal with you. Additionally, if you can close quickly, that's another massive one. Maybe somebody is coming up on a bankruptcy. Maybe that person needs money to fund a vacation or fund their kids' college, or who knows what's going on in their own personal life, but they might need that money quickly. And if you can provide it quickly, a lot of times that's considered a high value item where you can maybe get something for a little bit cheaper than you would be able to otherwise. Forced appreciation is the next one. Forced appreciation, the idea behind that is that You buy something that's beat up. It's got broken windows, the tenants destroy the entire inside of the house, and it needs a new roof. And you buy this place for a cheap price, but then you fix it up. You put a lot of work into it. Think about flipping, the Burr strategy, right? In those strategies, basically what you're doing is taking a bad property and making it nice again, right? So flippers do that all the time. And even with long-term real estate, that also works. There's some of these that we bought that were in pretty rough shape, and we cleaned them up. We got better tenants in them. We made some improvements along the way, and now they're better than at least they were when we got them. Therefore, we're raising the equity position. Market appreciation over time. Now, this one I can take no credit for. This is literally all of us just riding the same wave together, whether it goes up or down. We're all in this together in a lot of ways. The market appreciation, as you can see, I bought a lot of stuff in the very early post-COVID stage. And after the money printer went burr, prices in Milwaukee and a lot of places went nuts. So a lot of this stuff I can take no credit for. I didn't do anything special. I just was in the market. So they went up over time. And will that go forever? Absolutely not. Nothing is a straight line up or down. So you can't really anticipate what that's going to be. Milwaukee's seen a huge influx of people moving to this area because of the cheap cost of living. And so if you look at that, I could maybe extrapolate that into the future and say, okay, this is going to be something that's a trend that continues for a long period of time. But when you're seeing, I think Milwaukee saw a 17% average increase in price year over year. If you're seeing that, if you're planning on that every year, you're going to be putting yourself in probably a pretty rough position because it's unlikely to continue on that trajectory forever. But it's been going that way for a while. So now I have a lot of baked in equity that I just have because things went up over time. On the same note as that, we have the rents. Rents are a massive way to understand the value of a property. If rents go up, the property's value also goes up because you have to look at these as little businesses. If a business's revenue goes up over time, generally that business is worth more money. And then the same applies in real estate. Milwaukee has seen massive increases in average rents, and therefore the property values have also gone up because they're generating more money. It's just a little business. Every single one of these is just a small business that you're buying, basically. That's how I frame it in my mind. And so when you're raising rents, you're raising the income of the business. And so that's not always going to happen, though. They're not going to go up forever. I see a lot of people buying properties that are extremely expensive, but they're building in they're building in massive equity gains over time because of just market appreciation and the rents going up. And I just think that's scary because you don't really know what's going to happen. We could have World War III tomorrow. You have no idea what's going to happen. So if you're betting the farm on all this stuff going your direction, you're probably going to be left disappointed, and you're probably going to leave your investors disappointed. Like I said, I can't take any credit for things like market appreciation other than the fact that maybe I can be more aggressive with raising rents to try to generate more revenue, therefore raising the value of the portfolio or the property in specific. The next thing that you could do is just buy into a good equity position. Now, that really doesn't mean a whole lot because basically what I'm saying is you could just put a massive down payment down. If you pay cash for a property, you suddenly have 100% equity position in that property. But it doesn't really work out that way because that may be true on paper, but your money is still tied up in the deal, right? So there's an aspect of not wanting to have all your money tied up in deals. And honestly, what people tend to want to do is refinance these properties and get their money out of the deal so that way they can just hold them forever and basically have no money in the deal. Doing that maybe works for certain scenarios. There might be some situations where you don't want to pay a hard money lender and you just want to get the property. You have the cash sitting around, so it makes sense to use it. But it's not really truly equity in my eyes because it's still your own money that's tied up in it. It's not really, you're just moving it from the bank account into this property. And generally those are going to be some of the bigger ways that you're able to force equity into a property. Some of it takes a long time. If you look 2021, that's only been 4 years and there's been some massive moves in the market, but it's still been 4 years where we just sat on our hands and literally did nothing. And I would recommend that to a lot of people that are starting out as you're probably going to do more damage if you just do nothing sometimes. It's always fun to want to buy deals and flip and always have something going on, always have an iron in the fire. And eventually I think that makes sense because you have a large enough portfolio to sustain that. But I also think that there's a negative to that. And sometimes when you're trying to move too fast and do things too quickly, you can shoot yourself in the foot and set yourself back. And I've definitely done that outside of real estate. I've done that with stock trading and stuff. I've done a lot of things that I thought were going to do a lot better than they did. And I shot myself in the foot. I didn't bet my entire life on that, so that part saved me, but it's still a drawback, and it's something that I look at and say, oh man, where could I be today if I hadn't made these mistakes along the way? So if you're listening to this, I know it's not fun to sit on your hands and do nothing. It doesn't feel cool. You can't make an Instagram story about it. But sometimes that's the best policy, is just to do nothing. Now, transitioning over, how do I manage all this equity? And honestly, that's a question that I'm still trying to answer for myself. I don't have all the answers here. I've been trying to do my best to strategically make moves, but honestly, we haven't sold a whole lot. We've retained the majority of our properties, and we haven't even considered selling any of them. And that's because we wanted to build up a portfolio. We wanted to get the cash flow going. But as time has gone on, it's gotten more difficult not to touch these properties, because you can see some of these, we could be looking at about $250,000 just by selling 2 duplexes, losing 4 units, but getting $250,000 in cash. That's the problem, is the idle equity. The equity that we have tied up in all of this. We have $2.3 million worth of equity, but we're not using it. It's not doing anything for us. It's just sitting on the sidelines. And that's something that I'm trying to address this year, and definitely next year, is moving out of these deals, rotating into other deals, because a lot of these loans are all on 5-year adjustable rate mortgages, which means when their term comes due, for example, next July, the first one's going to come due, and we're going to go from a 4% interest rate roughly up to whatever the market is, which I expect to be somewhere in the 6s or 7s. So it's going to be significantly more expensive to keep that property. So that's a situation where we're looking at that and saying, okay, we need to do something about that, because we have about $250,000 worth of equity. And in the ways that we've been buying properties, that's about a $1.2 million purchase ability just off of 2 duplexes. And if you look at our equity position, about $2.4 million, just under $2.4 million, that's about $11 to $12 million worth of buying power out in the market if you're doing an 80% loan to value, which is what we've done with all these properties. So I don't want to be that leveraged. That's pretty high leverage. It's giving you a lot of ways to lose, but that's literally double our portfolio size. So when I'm sitting here looking at that, I'm like, man, we need to figure out a way to start growing, because we have all this idle equity, but we want to build this business even bigger. We want to get to 100 units. We want to get to 1,000 units. But the only way for us to do that is to smartly use this money. And so up to this point, we've just been sitting on our hands, but it's time to take our hands out from underneath our legs and say, okay, let's go make some moves. So we've been aggressively sending emails, doing tours. We just put in a couple offers. One of those offers I mentioned in my last video did not go through. The other one's still up in the air, but probably not going to happen. So it's tough, because we want to buy deals, but we also don't want to overcommit or to spend too much money on something that's not really worth it. And so we're still sticking to our principles, which makes finding deals hard. And therefore, we have all this equity that's doing nothing for us. Some of the best deals for somebody in this situation, in my mind, is something that has a forced appreciation aspect to it. So like that 12 unit that I toured, that would be a perfect scenario, because it's something that's beat up, it's run down. We can go in there, we can fix it up, we can make it better, and then move on. Another scenario that we think is enticing is a portfolio purchase, right? So we're buying 10 duplexes or 20 duplexes at a time instead of just 1 or 2 here and there. It's a lot more efficient. You can get a better deal generally too, because you're dealing with somebody that's maybe trying to get rid of their entire portfolio. And instead of going through 10 different buyers, 10 different inspections, 10 different appraisers, they can just deal with one person in and out. And we've had some pretty good success with buying portfolios like that. So there's a lot of ways that we think we can work this, but we haven't done enough, I don't think. I think we could be at least at a $10 million value on the portfolio, but currently we're at 5.9, just under 5.9 million. So we're a far cry from there. And a lot of that has to do with me. I'm running this thing. I'm generally the one that's working a lot of this stuff. So it's on me for not really pushing that hard. But there is something to be said for the peace of mind of looking at that and saying, hey, if anything goes wrong, if I lose my job at the airline, if the military kicks me out, if my friends lose their job and my partners lose their job, we can lean on this and say, okay, we'll just sell a couple duplexes and we're good for a couple of years. We can just hang out and figure life out. So there's like 2 sides of that coin, where you want to be aggressive, but you don't want to be so aggressive where you have no ability to make any moves. And that's one tough thing with real estate, is that it's not very liquid. So you don't have the ability to really quickly move through deals unless you're doing with some cash deals. And generally you're selling those at a kind of an attractive price to a cash buyer, which means that you're not getting the most out of it on the market. So that's what it looks like. The next question maybe would be, why don't I just live off this and just say, yeah, you know what, I made it to the top. I'm just going to chill out, drink a pina colada, and wake up in 40 years. And I guess that's just not who I am. That's not what I like to do. I like building this business. I like the challenge of trying to build something from scratch. This literally started with one single family flip house, and we built it to this, and I think we have a long way to go. So there's something attractive to me about doing that, and I don't think I'm going to stop. That's just what I love to do. I've really enjoyed this business and the challenge of trying to compete in one of the most competitive markets on the planet. So I'm not stopping anytime soon, but there is an argument to be said, you know what, I could just retire and just live a very modest lifestyle and just live off the interest. But these days, I don't even know if you could retire, even if all of that was mine, because I have partners. Even if all of that was 100% mine, I don't even know if you could retire off that these days. It's so expensive. I'm sure a lot of you have experienced the same thing. It is expensive out there, and I don't really know if that would be enough to get the job done. So let me know what you think it takes to retire in a 2025 world. A lot of people would say, why don't you just do a cash out refinance? And there's two arguments against that. I think one is that our a lot of our interest rates are much lower than the market right now. So we don't want to take on a larger interest rate if we don't have to right now because they're all so much more attractive. And the other thing is, when you're doing a cash out refinance, a lot of loan programs will not let you take out more than 60, 70, 80% loan to value. So on some of these properties, we couldn't even get money out of it if we wanted to. And lately, what I've been seeing a lot of is about 70, 75% loan to value. They've been a little bit more gun shy with the high leverage deals, which is totally fine. But if you're looking at this, some of these, if I have one that's from 420 of 23 and it's at 0.74 loan to value, there's nothing I can do with it. That's already, and actually we did a cash out refinance on that one, so that makes sense. But there's nothing you can do with some of these deals. They're just dead in the water. The biggest thing that you could do maybe is to portfolio them all, put a bunch of them all into one loan, and then try to do a cash out on that. But it's not as simple as just doing a cash out refinance. A lot of people online just talk about the BRRRR strategy and just say, okay, buy, rehab, rent, refinance, repeat, like it's no big deal. But a lot of the stuff is not that simple unless you have a really big equity position. And even then, you may only get 80% of the money that you originally thought you were going to get because they're not going to let you go to 100% loan to value, which means that your profits are capped. So if you buy a place for 100, you put 50 into it and it's worth 200, you may only get 150, 160 out of it. So your spread on that is basically nothing, if not very tight. That's something to think about. You really need to understand that before you start doing this because that's how a lot of these flippers get screwed. They don't realize that they can't just get all their money back out of it. They only get a percentage of it. And then they're like, I guess I don't have enough money for another deal or I need to sell this place. And it turns into a nightmare. So anyways, that's a tangent, but that's what the portfolio looks like. You can see the progression from the oldest deals to the most current deals and the ones that haven't even closed yet. That's why there's question marks all over that. But I hope that the look inside this portfolio has been helpful. If you thought it was helpful or interesting, let me know in the comments, like, subscribe. I really appreciate all of that. And again, like I've always said, if you're watching this, I know you could be anywhere on the internet, but somehow you're here listening to me. So I truly appreciate it. I'm here to try to answer some real estate questions and try to show my own portfolio building as time goes on. So if you have anything else that you want to talk about, please let me know. I'll make a video about it. I've got a couple in the works already. Anyways, I appreciate you guys and I'll talk to you soon. See ya.